Listen, if you weren't watching the commodity markets at 4 a.m. this morning, you missed something massive. Not a price spike, not a rally, a fundamental shift in the global uranium supply chain that's been 15 years in the making. And while everyone's distracted by the AI boom and semiconductor stocks, the fuel that's going to power the next decade of energy infrastructure just hit a critical breaking point. The spot price you're seeing on your screen right now, it's a lie. Or more accurately, it's incomplete. Because while Western exchanges are showing uranium at $87 per pound, the actual contracts being signed behind closed doors are coming in at $115 to $125. That's not a premium. That's a different market entirely. I'm not a YouTuber. I'm a nuclear energy analyst who spent the last decade tracking uranium supply chains, reactor construction timelines, and the gap between what utilities need and what miners can actually deliver. I built this channel with an AI avatar for one reason: speed. Because by the time Bloomberg or Reuters catches up to what's happening in the conversion facilities and enrichment plants, the information is already 48 hours old. And in a market this tight, 48 hours might as well be a lifetime. Here's what nobody's telling you. The spot price of uranium, that $87 number everyone's focused on, represents less than 15% of actual transactions. The real market is in long-term contracts, and those contracts are being signed right now at prices that would shock most retail investors. Utilities are locking in supply at $120 plus because they know what's coming. They know the math doesn't work, and they're willing to pay whatever it takes to keep their reactors running. Let me walk you through the structural problem that's about to break this market wide open. Right now, global uranium demand sits at approximately 180 million pounds per year. That's what the world's 440-plus nuclear reactors consume annually just to keep the lights on. Current mining production? About 140 million pounds. You don't need a PhD in mathematics to see the problem. We're short 40 million pounds per year, and we've been covering that gap by drawing down secondary supplies: old Soviet warheads, depleted inventories, recycled fuel. But here's the thing about secondary supplies. They're finite. And according to the data I'm seeing, we're about 18 to 24 months away from running dry. Kazakhstan produces 43% of the world's uranium. Canada produces another 15%. Australia has massive reserves, but permitting timelines are measured in decades, not years. And here's the kicker. Even if you greenlight a new uranium mine today, you're looking at 7 to 10 years before the first pound of U3O8 comes out of the ground. 7 to 10 years. The utilities signing contracts today don't have 7 years. They have 18 months before their current fuel inventories start looking dangerously low. So what are they doing? They're panic buying. They're signing any contract they can find, and they're driving the real price of uranium into triple digits, while the spot market, the tiny sliver of transactions that happen on exchanges, is still pretending everything's fine at $87. Let's talk about China for a second, because this is where the whole thesis goes from concerning to critical. China currently has 55 operational nuclear reactors. They have 23 under construction right now, and they have plans to build another 40 to 50 over the next decade. That's not speculation. Those are publicly announced projects with allocated budgets and construction timelines. Do the math with me. Every reactor needs approximately 400,000 pounds of uranium per year to operate. So 50 new Chinese reactors means an additional 20 million pounds of annual demand hitting the market over the next 10 years. 20 million pounds. In a market that's already 40 million pounds short. And here's the part that should terrify Western utilities. China's been stockpiling. For the last 3 years, Chinese state-owned enterprises have been buying uranium on every dip, building strategic reserves, locking in long-term supply agreements with Kazakhstan and Namibia. They saw this coming. They positioned for it. And now Western utilities are waking up to find that a significant portion of future supply is already spoken for. But wait, it gets worse. Because uranium doesn't go straight from the mine into a reactor. It has to be converted from U3O8 to UF6. Then it has to be enriched from 0.7% U235 to about 4 to 5% U235. And there are exactly 4 major enrichment facilities in the world capable of doing this at scale. Russia controls about 40% of global enrichment capacity. After the war in Ukraine started, Western countries started looking for alternatives. The problem? Enrichment capacity can't be built overnight. We're talking about highly specialized facilities with massive capital requirements and strict regulatory oversight. Right now, there's a 14 to 18-month waiting list for enrichment services. Utilities with uranium sitting in storage can't use it because they can't get it enriched fast enough. So even if you solve the mining shortage, you still have an enrichment bottleneck that's going to keep supply tight for years. This is a structural crisis with no short-term solution. I want to show you something that's been bugging me for months. Pull up the annual reports from major utilities: Exelon, Duke Energy, EDF, any of the big nuclear operators. Look at their fuel procurement sections. Notice anything? They're not talking about spot prices. They're talking about contract coverage ratios. They're talking about securing supply through 2030 and beyond. They're using language like strategic fuel security and long-term supply diversification. That's corporate speak for, we're scared. Utilities don't get scared about commodities unless there's a real risk of not being able to source what they need. And right now, they're waking up to the reality that the uranium market is fundamentally broken. There's not enough supply, there's not enough enrichment capacity, and there's a massive wave of new demand coming from China, India, and the global push for clean baseload energy. So what are they doing? They're bidding against each other. They're signing contracts at $115, $120, $125 per pound. They're locking in supply for the next 10 to 15 years because they know that in 24 months, the price could be $200 and there still might not be metal available. The small miner explosion. Here's where this gets interesting for investors. The big miners, Cameco, Kazatomprom, Orano, they're already producing flat out. They can't meaningfully increase production without years of lead time and billions in capital investment. But there are about 30 to 40 junior uranium miners sitting on deposits that were uneconomical at $60 uranium, but become wildly profitable at $100 plus. These companies have been in survival mode for a decade. They've been waiting for this moment. And now, with utilities desperate for supply and willing to sign long-term contracts at elevated prices, these juniors are getting funded. They're restarting old mines. They're fast-tracking new projects. They're signing offtake agreements that guarantee cash flow for the next 10 years. This is where the asymmetric opportunity exists. The majors are already priced for higher uranium. The market knows Cameco is going to do well. But the juniors, most retail investors don't even know they exist. And the ones that are paying attention are about to see a wave of production restarts and new supply agreements that could 3 times or 5 times these companies over the next 24 months. The contrarian take: what could go wrong? Let me steelman the bear case, because if I'm wrong, I want to understand why. The skeptics will tell you that high uranium prices will kill nuclear demand. Countries will pivot to renewables and natural gas instead of building new reactors. The uranium price will spike, trigger a wave of new mining supply, and crash back down just like it did in 2007. There's also the substitution argument. Maybe reactors can run on lower enrichment fuel. Maybe utilities can stretch their fuel cycles. Maybe Russia floods the market with enriched uranium to undercut Western prices and maintain market share. And then there's the recession risk. If the global economy rolls over, electricity demand drops, and utilities might delay reactor refueling or even shut down marginal plants. These are legitimate concerns. I'm not going to dismiss them. But here's my rebuttal. Nuclear demand isn't discretionary anymore. It's structural. Countries around the world have committed to net zero carbon targets. Solar and wind can't provide baseload power. Natural gas is politically toxic in Europe. Coal is being phased out everywhere. Nuclear is the only scalable, carbon-free baseload energy source that exists. And once you commit to a nuclear program, you can't just turn it off because uranium gets expensive. You're locked in for 40 to 60 years. As for new supply, sure, high prices will eventually bring new mines online. But we're talking about a 7 to 10-year lag. The deficit is happening now. The new supply won't arrive until the early 2030s at the earliest. And regarding recession risk, electricity demand is remarkably inelastic. People don't stop using electricity because the economy is bad. Industrial users might cut back slightly, but baseload demand stays relatively stable even through recessions. So yes, there are risks, but the structural supply deficit is real, and it's not going away anytime soon. What I'm watching right now, I'm monitoring 3 specific triggers that will tell me if this thesis is playing out or falling apart. Trigger 1. Cameco's contract announcements. Cameco is the largest publicly traded uranium miner. When they announce long-term contracts, they disclose the volumes but not always the prices. I'm watching for any indication that contract prices are above $110. If Cameco starts signing deals at $115 plus, that's confirmation that the utilities are panicking. Trigger 2. Kazakhstan production data. Kazakhstan can increase production, but only to a point. If we see Kazatomprom guiding for flat or declining production over the next 2 years, that's a massive red flag. It means the world's largest producer can't fill the gap. Trigger 3. Spot price divergence. Right now, spot is at $87, and term contracts are reportedly at $115 plus. If that spread widens to $40 or $50, it means the spot market has completely decoupled from reality. It means utilities have given up on spot and are only buying term. And that's when things go parabolic. My personal positioning. I can't tell you what to do. I don't know your risk tolerance or financial situation. But I can tell you what I'm doing. I'm holding positions in 3 categories. Category 1. The majors. Cameco and Kazatomprom. These are the steady hands. They're going to benefit from higher prices. They're not going to 10 times, but they're also not going to 0. This is the core position, 40% of my uranium exposure. Category 2, the juniors with near-term production, companies that are 12 to 24 months away from restarting production. These have more risk, but also more upside. Maybe 3 times to 5 times if uranium holds above $100. This is 40% of my exposure. Category 3, the deep value explorers, high risk, high reward plays. Companies sitting on large deposits that need $100 plus uranium to be economic. If this thesis plays out, these could 10 times, but they could also go to 0 if uranium crashes. This is 20% of my exposure, money I can afford to lose. And here's my exit plan, because you need to have one. If uranium hits $150, I'm taking 30% off the table. If it hits $200, I'm taking another 30%. The last 40%, I'll let it ride and see where it goes. Because here's the thing about commodity supercycles. They overshoot. They always do. Uranium could go to $250 or $300 if this turns into a true supply crisis. But it could also crash back to $80 in 6 months if something breaks. So I'm not trying to time the top. I'm taking profits on the way up and letting a core position run. Here's what's going to happen if I'm right. The institutions are going to wait. They're going to watch uranium climb to $100, then $120, then $140. And the whole time, they're going to tell themselves it's a bubble. They're going to wait for the pullback. And then one day, a major utility is going to announce that they can't secure fuel for a reactor refueling scheduled 18 months out. Or Kazakhstan is going to have a production disruption. Or China is going to announce they're accelerating their reactor construction timeline, and uranium is going to gap up $30 in a single day. And that's when the institutions will panic. That's when the ETFs will start buying. That's when your financial advisor will finally tell you that maybe you should have some uranium exposure. But by then, the easy money will be gone. The juniors will have already 5 times. The majors will be priced for $200 uranium. And retail investors will be buying at the top, just like they always do. I'm not saying you need to go all in on uranium today. I'm saying you need to understand what's happening. The supply deficit is real. The demand growth is real. The structural bottlenecks are real. And the window to position before the mainstream figures this out is closing fast. So here's what I need you to do. Don't take my word for any of this. Go pull the data yourself. Look at the World Nuclear Association's supply-demand reports. Look at utility fuel procurement disclosures. Look at the production timelines for new mines. It's all public information. You just have to know where to look. And if you do the work, if you see what I'm seeing, then you have a decision to make. Are you going to position for this? Or are you going to wait for CNBC to tell you it's safe? Because by the time CNBC covers it, uranium will be at $180 and the opportunity will be gone. Watch Cameco's next earnings call. Watch Kazakhstan's production data. Watch the spot price and the contract price spread. And most importantly, watch the utilities. Because when they start panicking, that's when this goes vertical. The data doesn't lie. The reactors need fuel. The miners can't produce enough. And the gap is widening every single day. That's it. That's the thesis. Subscribe if you want real-time updates on the uranium market. Hit the bell if you want to catch these before the institutions figure it out. And leave a comment telling me what you think. Am I missing something? Is there a bear case I haven't considered? I'll see you in the next one. Stay sharp.